I know we had the Secure Out. I know we had the Secure Act, 1.0, 2.0, and there's definitely good stuff going on here. But this one, I think, does bring opportunities for all of you as business owners and also on the personal side to save money on taxes. So let's first things first, I guess. Everybody's on social media, so if you want to connect and follow me, I'm always sharing tax tips, commentary in regards to accounting and the current economy. Feel free to follow me on LinkedIn, Facebook, Instagram, social media. There's some QR codes there. Uh, excuse me, or my handle is at Aprile CPA. So with that out of the way, let's continue to the next slide. Oh, disclaimer, of course. So this presentation is for informational and educational purposes only. It should not be considered personalized tax advice because every situation is unique and individual. So we strongly suggest that you contact a tax professional or your tax professional for specific questions that you may have in regards to your current situation. Okay. So with that out of the way, let's talk about the One Big Beautiful Bill Act. I know it's a mouthful. Some people are calling it OB3 and HR1 and on and on and on. I'm sure things will filter out as they always do from a branding standpoint. So this got passed on 4th of July. So it's a really brand new bill. There is still a lot of guidance that has to be released, but I'm going to be doing updates every so often to keep you guys abreast when new stuff comes out, right? So, the bigger thing is extended a lot of the provisions that the Tax Cut Jobs Act gave us, both at the personal level and the business level. Okay, but also there are some changes and there's new tax provisions that I find very interesting. So this presentation is geared towards the business owners. I want to talk about business first, and then after that, we're going to talk about the tax implications at the personal level. At the end of the day, most of you, I would say 99.9% of you, do not pay taxes at the business level, but you do it at the personal level, whether you're a sole proprietor or you're in a partnership or have an S corporation. The only instance where you will be paying taxes at the corporate level is if you have a C corporation. And if you don't know what that is, you probably don't have it, but usually at larger organizations. So let's concentrate on what the impacts are at the business level, but also at the personal level. Okay. So the first thing they did extended and improved the depreciation on this new tax bill. So we're going to talk about Section 179, bonus depreciation, and a new category, which is depreciation on qualified production property. So that's something new that this bill is bringing to the table. Section 179, if you have not heard of this before, it's been around forever. What they did or what they changed, they actually increased the limit on this depreciation up to $2.5 million. And that was increased for 1.25, so it really doubled the amount. And after 2.5, it's gonna, it's gonna start to get phased out until you hit 4 million. And after that, well, you cannot deduct that anymore. The asset must have been put in place by January 1st of 2025, but you got the whole year to do it. So if you're able to buy an asset and put it in service by December 31st of this year, you're still able to get that deduction. So that's very important. Sometimes you get down to the wire, you get a big tax, a big increase on your income, whatever that may be, a big contract or something like that, and now you're scrambling because you know that your taxes are going to go up. Maybe that's a good option for you to look into. And I would definitely suggest that you talk to your tax professional before you pull the trigger. Once you pull the trigger, it's done and there's nothing you can do. So have that conversation with them. Okay. Another cool thing about it is going to be indexed for inflation. So every year that amount, the 2.5 is going to increase every year and it's going to be adjusted for inflation. The qualified properties, machinery, equipment, software, vehicles, it has limits. Sometimes people go nuts and say, I'm going to buy a luxury vehicle, I'm going to depreciate the whole thing. Well, there are certain limits on that. So again, before you pull that trigger, check it out and see what that picture is going to look like for you and your situation, right? Certain improvements on the property that may qualify as well. Okay, so let's look into that. Additionally, bonus depreciation has been restored to 100%. Before this law got passed, this year bonus depreciation was going to be held at a 40% tax rate, and next year it was going to be 20%, and by 2027 it was going to be 0%. So this tax law basically put the 100% bonus back on the table, which is great. A little caveat here, this is only for assets that were placed in service after January 19, 2025. The day, well, you draw your own conclusions on why that is, but that's where it's at. Now, here's the cool part. You can use both depreciations. You can do Section 179, and if you hit that limit, then you can use the bonus depreciation. You can use them both together and try to find out what's going to be the best strategy for you on how to apply these depreciations. And this bonus depreciation has no limit. So that's great if you're, you have lots of equipment to purchase or whatnot. I think this is a great strategy, a great tool for you to do it. But again, you need to take a look at your whole situation, because I see people perhaps this year don't have enough taxable income. And they say, well, I'm going to buy the equipment so you can deduct. Well, if you have no income, you got some losses, it may be beneficial for you. But again, before you pull the trigger, you need to understand your current situation to see what's going to be the most beneficial to you and your business. Okay. Now, so here is a new provision, which is 100% bonus depreciation for certain qualifying real estate properties. Usually, you don't see 100% depreciation on real estate. That's very rare. I've never seen it, to be honest with you. Now, obviously, there is a catch. It's only for qualifying production property. So what does that mean, right? Well, definitely cannot be a residential property. That's out. It must be used as the integral part of a qualified production activity. What the heck does that mean? We're going to cover that in a little bit. Must be placed in service here in the U.S. or a U.S. possession. So I'm assuming Puerto Rico or some kind of U.S. Virgin Islands or whatnot. And that's like a little clarity there, but I'm sure we're going to get guidance soon on that. And it must be built between January 20th, 2025, all the way through December 31st of 2028, and must be placed in service by 12/31/2030. So I think that's a great opportunity if you have a business that has qualifying production activity. So again, this is mostly an incentive by the president to bring manufacturing back into the US. Say, hey, you want to manufacture here in the US? Well, we'll give you a break on the building you're going to build and depreciate that and save on taxes. Or manufacturing, producing and refining tangible personal property, agricultural and chemical production as well. So if your business is in these industries, definitely take a look into this and see what your strategy would be now that these tax implications are on the table. I think this is a great opportunity for the right industries. Now, things don't qualify. We talk about, again, non-residential, residential stuff, software development, engineering, research, lodging or offices use. So if you, myself as a CPA, if I buy an office, that's not going to qualify. Period. It is what it is. Now, retail sales, that's not going to count. So it's all about production and manufacturing. Really, that's what we're looking at here to be able to access to this 100% deduction. So with that said, is this making you want to buy equipment, right? Whether it's equipment, vehicles, real estate, anybody? Yeah. There you go. All right. So now, the next thing I want to talk to you guys about is a qualified business income deduction. Are you guys familiar with it? Show of hands, if anybody can show hands there. No? So this is nothing new. This is part of the Taxes Jobs Act that we had in 2017. And it was going to sunset after this year. So they were going to get rid of it. So long story short is you can get a 20% deduction on your business income. That's big money, potentially. But thanks to this law, this is going to be permanent now. So if you don't know if you have it or you've seen it in the past, when you're bored, take a look at your 1040 tax return and you're going to look at line 13, if I'm not mistaken. It says qualified business income deduction. And that's that's what you need to take a look at to see what kind of deduction you're getting. So let's say for simplicity's sake, that in 2014, I'm sorry, 2024, not 2014, 2024, you had a qualified business income deduction of $10,000. And and if you're in a tax bracket that is 22%, then you are basically getting a tax reduction of about $2,200 in your federal taxes. So that's a good chunk of money, right? So take a look at that. So again, this was going to end this year. So starting 2026, still going to continue, and that's going to be permanent. Another good news is the deduction limitation phase-out range has increased to 150,000 for married filing jointly, and half of that for everybody else. Currently, it's 100,000 for married filing jointly, and everybody else is 50,000. Why is that important? Well, it's one of those deals. Every law has this. If you're making too much money, then that benefit may go away. So it's they give it to you with one hand and take it away from the other. So uh, let's take a look at what that means, right? So that you get a 20% deduction is a fully deduction allowed if income is under $394,600 if you're married, filing jointly, or half of that for everybody else. So what that means, once you hit that threshold of $394,000, depending on what kind of business you have, you are gonna phase out of that benefit until a point that, depending on what your business is, you may see $0 in that deduction. Right. So, and that's going to depend on what type of business you got, especially if you're a specified service trade or business, SSTB. That's the designation. Unfortunately, my business is under that designation, along with health, law, actuarial services, consulting, really anything that the value that is brought is by my expertise, right? So if you're doing coaching, financial services, or whatnot, those people or those businesses are considered SSTBs. And the reason why it's important is if my business or I make too much money, because this is done at the personal level, is let's say if I make my taxable income is more than $496,000 and change, then the deduction that I would have goes to zero. I would lose that 20% deduction. So that's very important. If you guys find yourself at that level, and again, doesn't have to be all your business income. Let's say you got a spouse that makes really good money. You may also be subject to that deduction to go away because you get past that threshold. So as an example here, probably maybe it's hard to read, but I ran in a scenario where if you got your business just by increasing your revenue by $100,000, still a lot of money, don't get me wrong. But if you increase your business by $100,000, go from 396 and change to 496 and change taxable income, you could potentially pay 48% of all that in taxes. So when somebody tells you, well, sure, you're going to increase your sales by $100,000, but then they tell you, hey, you got to pay 48% on that. I'm like, not sure what my motivation is going to be. So if you find yourself in that situation, do talk to your tax professional. Let's see if you guys can come up with strategies on how to reduce your business income so you're still able to claim that deduction. Okay, but again, you need to be proactive. Once everything is said and done, it's going to be very difficult to turn that time machine to go back into the year. So the best time to take action is now. Right. So now what happens to those people, those businesses that are not considered SSTBs? Well, good news, you're still eligible for the deduction. Things are just get more complicated. So there is a special formulas on that. So let's say you got a construction company, you've got other businesses, that are not considered SSTBs. You're still able to do it. It just gets a little more complicated. So again, that's the good news. But again, check to see what, do a project to see what the picture is going to look like, because you still may leave some money on the table. Yeah. Now, if anybody of you, or somebody's got a side hustle, maybe one of you just thinking about getting started in business, effective next year, there is going to be a floor on this qualified business income deduction. So the only thing you have to do is make at least $1,000 and that you have to materially participate. That's it, right? So if you bring $1,000 to the table, Schedule C, more than likely, then you get an automatic $400. So that's a little bit of help, right, to get started in your first year if that's what you're looking at. That's a little bit of an incentive from the government. Nothing earth shattering, but again, I'll take it. All right. So now enhanced R&D deductions. Definitely the government is again incentivizing businesses to invest here in America, do more R&D here locally. And actually it's very, very interesting. You can actually do amended returns to go back to 2022 and claim those deductions now, because before you had to capitalize them. Now you can actually claim those deductions when their expenses are paid or incurred in the taxable year. So again, if your business has a lot of research and development, this is something you want to take a look at, and perhaps look at your prior years for 2022 and 23 to see, and 24 now, to see if there is any opportunities for you to amend those returns and get some money back. Let's see here. Let me go back. All right. Let's talk about 1099s. I know everybody loves getting 1099s or issuing 1099s. Through 2025, if you did pay or receive $600 in services, you need, or more, you need to issue 1099. Usually it's an NEC. But effective 2026, that amount is finally go up. I think that amount has not changed since 1986. It's only been 40 years for the government to get this act together in this department. So the new amount is going to be $2,000, and it's going to have to exceed. So if you pay somebody $2,000 only, you don't have to issue the 1099. But if you pay them $2,001, guess what? You have to issue 1099. So that's going to alleviate that pain of those smaller contractors that you pay. And moving forward in 2027, that's going to be adjusted every year. So we don't have to wait another 40 years to update that amount. So I think that's great news. Again, remember, just because you did not get a 1099, that doesn't mean you don't have to report the income. You still have to report the income. It's just now you have proof that that money was paid to you. Okay. So that's a little bit of happy news and kind of lessen the burden of business owners, because it does become a cumbersome project when you got to issue a bunch of 1099s. Now, let's switch to the individual part. Again, as I stated at the beginning, in most instances, you will be paying taxes at the personal level, not your business level. If you file a Schedule C, a partnership tax return, an S corporation, those entities do not pay taxes, income taxes directly. All that's transferred to your personal tax return, and then that's how you pay taxes. So this new law is actually upping the standard deductions, but actually are making it permanent. Before this, we were gonna go back to smaller standard deductions, but nope, they're here to stay, and they actually increased them. They did an inflation adjustment, so it was gonna be 30,000 for married family jointly. Now it's gonna be 31.5, and say for everybody else, the household and all others. So that helps quite a bit. In a lot of instances, itemized returns do not look that great, because again, you have to really justify it to have itemized tax returns. Okay? And again, this is effective this year. And thanks to this law, we keep the same tax rates that we have this year. I mean, if you can take a look at that, I'll take these current rates compared to 2017 ones. Although they may seem small, I see the big difference here between 12, 22% and 15, 25%. A lot of people find themselves in these brackets. So I think right there, I think these are the wins and helps people that find themselves in the 22, 24% tax bracket. I call that a win. Another provision that is going to stay is the mortgage interest deduction cap is up to $750,000 loans. That's been the same for a while now, since the Tax Cuts and Jobs Act. But now you're able to deduct PMI again, which that was not happening before, and this is effective in 2026. Now, this is something really good. SALT deductions. Until last year, 2024, the cap for SALT deductions is $10,000, but now they up it to $40,000, 4 times as much. Now, SALT means state and local taxes. And what's happening is to a lot of people that were doing itemized returns, and they had SALT taxes that were over $10,000. Well, guess what? Doesn't matter. Your cap is 10,000. So that, and a lot of people are not happy, especially people in back east that are paying property taxes of 20, 30,000 a year. You can see that that's affecting people's pocket big time. So they made it $40,000. Um, there's still a phased out provision if you're making more than $500,000, and it's going to revert back to $10,000 in 2030. So this is not permanent; it's temporary. So I think this is a big win for people that do have a lot of state and local taxes, and that means the taxes that you pay. Let's say you have a spouse and they do really well, and you pay a lot of taxes at the state level. That's affecting you right there. You bought a vehicle or whatnot, the property taxes you pay at home, all those things sometimes we don't think about. Well, there was a cap on that, so now it's going from 10 to 40. So it can bring a lot of benefit to you if you file an itemized tax return. Here. All right, so let's talk about the most exciting part of this presentation. Although this is for business, I know you guys will benefit from this. So these are all new provision. These are above the line deductions. What that means is that you do not have to file an itemized tax return. You can take your standard deduction and you can add these deductions as well. Okay, so we got charitable donations, car loan interest deduction, senior deduction, no tax on overtime, and no tax on tips. Now, I did not include the last two, no tax on overtime or no tax on tips, because really, as a business owner, you're not claiming these deductions. These are more for your employees. So these things are definitely important, and they're going to be very important at time of reporting. I see you, Noemi. So if you're doing payroll or whatnot, you need to as a business owner, you need to contact your payroll company and make sure that this information is provided properly, because otherwise you as employers will have many, many unhappy employees. So let's discuss the first one, charitable donations. So effective next year, 2026, you're going to be able to donate up to $2,000 to your favorite charity, and that's your married family jointly, or half of that for everybody else, and deduct that. I mean, we saw that like after COVID, right? 21, 22, if I'm not mistaken, we were able to do that, but it's a much larger amount. I like this because you're able to donate and make an impact of to your charity. I like it. Now, if you make too much money and you file itemized returns, you're still able to do it. There's a little details on that, but the most important part for most of us, I would say, it's great to make these type of donations and that they can be deductible even if we do not itemize our return. Now, the following, oh, there we go. So the following deductions are only temporary. They're not forever. They start in 2025 and they're gonna be over in 2028. The first one is the car loan interest. Now is deductible up to $10,000, but obviously it's not going to be every vehicle that is financed. Must be a qualified vehicle only. There is no list really, but really the biggest thing is the vehicle must be assembled in the US, right? And it does not have to be an American car. It could be a Japanese vehicle with a factory in the US, right? So, but again, it must be assembled in the US. We still need a little more guidance on that. But I mean, that's the gist. If you're able to purchase something, then just keep track of that information. I'm sure more information is going to come up, but I think this is a great opportunity for someone who may have already bought the vehicle and financing it, or they're thinking about it. Now, with that said, if you make too much money, they will take that away from you. So if you're you're making more than $200,000 married filing jointly. Well, guess what? That's gonna go. That's gonna get phased out and go away, unfortunately. All right. No tax on seniors. I know Trump talked about that. Well, he was not able to get that. So the best thing that he did is get you an individual exemption. Right. It's up to 12,000 married filing jointly. Does require a social security number. Okay. If you don't have it, you have an ITIN or whatnot, that's going to be tough. And again, if you make too much money, they're going to get rid of that for you, or it's going to start to phase out for you. Now, let's take a look at no tax on overtime. I've been getting questions about this. Number one, if you're married, you need to file married filing jointly to claim this deduction. Maximum deduction is $25,000 for married filing jointly. If you're single or everybody else, that's half of that, 12,500 bucks. Again, if your modified adjusted gross income is too much money, in this case 300, 150, well, that's going to start phasing out and to get to a point where you really are not going to be able to claim this deduction. Again, if you make too much money, unfortunately, they will punish you. Right. You must have a social security number, but it also must be valid for work. So if you have a social security, but it's not valid, unfortunately, you will not be able to take this deduction. Now, the overtime must be required under FLSA, which is the First Standard Labor Act. So really what it is time and a half, right? They're usually standard time and a half overtime, but you do not get to deduct the time and a half. You only deduct that half portion or that 0.5 hours. Not 0.5, 0.5 compensation, whatever that may be, right? So that's all you get. So here's an example real quick, right? Let's say somebody works at 20 bucks an hour. They get about 250 hours of overtime, and then their overtime total rate is 30 bucks. So that extra 10 bucks, that's what's subject for deduction, not the whole amount. I just want to bring some clarity to that because people say, oh yeah, every $30 times whatever times 100. That's not how it works. It's gotta be only the extra money that you're making for overtime. Just to bring some clarity on that. Let's see here. Now, no tax on tips. I like this one better. Unfortunately, people like me, CPAs, cannot take advantage of it because historically we do not take tips. I want to change that, but for the time being, unfortunately, the only people who claim these type of deductions are people that customarily receive tips. I have a QR code, and this is just going straight to the source. It has a list of all the type of professions that customarily accept tips. So scan it, take a look at it. I can also give you a link. I can put it in a chat box real quick. Let me see. Of course, technology is not helping me out, but I'm sure we can forward it later. So, but I mean, there's a QR code if that works for you guys. But yeah, you can take up to $25,000 in deductions on qualified tips. Now, what is a qualified tip, right? So it can be cash, it could be card-based tips, or any amount received under tip sharing agreements or tip pooling or whatnot. That's what they're calling today. But remember, it has to be voluntary, cannot be subject to negotiation, and has to be determined solely by the owner type of deal. So let's go like the most common place you'll think about a restaurant, right? Like let's say, oh, if it's a party of 6 people plus, then they charge you a fee, right? Right off the bat, 18, 20%, whatever they're doing nowadays. Now, is that a tip? Well, it's kind of mandatory, so it's not determined by me, the customer. So unless we get some guidance, a little bit of a gray area there. Definitely interesting to navigate on that. Let's see here. Now, in order for you to deduct this tip, it has to be reported on IRS approved forms. So what does that mean, right? I mean, it could be your W-2. I'm looking at you, Noemi, again, payroll, right? Your credit card forms, 1099 Ks. Sometimes credit card information or reports, there's information of those credit cards breaking down what sales are, taxes are, tips. So that's something interesting. Self-employed people are also eligible. So let's say you got no mobile bartender and you do accept tips or whatnot, you're also eligible. It's just again you gotta have good records. Most of you guys will probably use some kind of payment toast or whatnot, and I'm sure those type of um, POS systems is able to break down your tips. So that's important information. So the way you do it is the tip is part of your income, and you declare that on your Schedule C, and then you take it back on the 1040. So it's a little bit of a wash, but again, increases your income, and then you're able to deduct it on your personal tax returns. Remember, you need to file married filing jointly if you're married. If not, you're not able to take this tax deduction. And again, if you make too much money, you get penalized for it. And you need to have a valid social security number for work at the time of filing. So, and it's at the time of filing. So if you are in the process of, getting a valid social security number for work, but you're not there yet, maybe next year you will, and if you're able to file on time, then you're able to claim this deduction. Otherwise, you can't. Another good news is the child tax credit is here to stay, right? In 2026, it's going to go back to $1,000 per child. Now is going to number one is permanent, but number two, it has been increased for 20 to 2,200 bucks per child. So I think that's great. The refundable portion goes up. You need a social security number. Again, you hear the theme, right? Social security number is needed for a lot of these type of credits and benefits and deductions. Stuff like that. And again, if you do make too much money, you lose out on this deduction. So I seen business owners where they start making really good money. You had $400,000. So not only you missed out on your qualifying business income deduction, which is 20% if you're an SSTB, but then if you're making too much money, then guess what? You hit half a million and all your credits go away. So they hit you on the deduction side. All these items we just talked about. You can make $500,000. And again, for a year, right? You're making $500,000, but it's still, this is real. You missed out on all these deductions and your child tax credit goes away. So if you're finding yourself in this position, you really want to take a look at your tax strategy. Right, Trump accounts. Has anybody heard here about the Trump accounts? All right. So this is effective next year, really effective in July of next year. So if you had a kid in this year or you're planning to have a kid until 2028, the government is going to contribute to that kid's account $1,000. That just for that sole fact or whatnot, it's going to give you $1,000. So maybe that's motivation enough for you guys to have a kid. I don't know, but that's what it is. But you as parents can contribute 5,000. You don't have to be a parent; you can be a grandparent too. $5,000 for each child that you got. Now the bad news is these contributions are non-tax deductible. So it's kind of like it's with after tax dollars, you're not going to get tax breaks. The money on those accounts are going to be growing tax free or tax deferred. But as far as I understand it, once the kid pulled the money out, it's going to be taxable. So again, they seem interesting, but I would say, it may not be the right fit for you, or it may be the right fit for you. But I think definitely, if you have a child and you got $1,000, well, that's free money, and I'm always a big fan of free money. There you go. Do what you do with that type of deal. And yeah, this is only valid and for children under 18, and the monies can only be taken out once the child turns 18. This year. Something good about this bill too is 529 accounts. You're actually increasing the limit of how much money can be spent per student. It's going to go up to $20,000 in 2026, and they're adding more eligible expenses, right? So now you can cover tuition for public, private school, religious schools from K through 12. So to me, that's a big deal because, we always had this, well, 529 can start for college only. Well, not anymore. Starting in 2026, now you're able to do all this at the lower levels of education, which I think great. The more options, the better it is, right? And that can cover tuition, books, materials, tutoring, etc. So, and the cool part about it is not everybody has to go to college. You can also get workforce training, trades, plumbers, electricians. Guess what? Now you can pay for for that type of education with 529 funds. So I think I welcome this. I think this is a smart move uh, for this tax bill. Energy credits. Well, sorry to tell you this if you haven't heard, but most of the energy credits that you saw, they have gone bye-bye already, or they will be gonna be phased out this year and some next year. The most popular one was the $7,500 credit on clean vehicles. Well, that ended on September 30th. So, you're not gonna see that. This year you're gonna have the energy efficient home improvement credit again gone, residential clean credit gone, and others gone by June 30th, 2026. So you're considering these type of green energy credits, you definitely want to get moving right away. Talk to your specialist, talk to your tax advisor, and see if this is feasible. I mean, I know some of these things, do take time, and you just may not have it. Now, one thing I want to talk to you guys about, I'm a big fan of this, the Arizona tax credits. There are several. By my favorite one is the Qualified Charitable Organization Tax Credit. You can definitely make an impact. For 2025, you're married filing jointly, you can get a tax credit of up to $987. And guess what? Local First Arizona, through its foundation, does accept charitable organizations. So if you believe in supporting them, you can donate to Local First Arizona Foundation. And what I like is I tell the government how I'm going to pay, how I want my tax dollars to be used. This is a non-refundable credit. So if you pay no taxes, this may not be it. But if you pay taxes every year, I urge you to look into this. There is also tax credits for donations to public schools, student tuition organizations, foster care organizations. Again, there is a QR code here with a link of all the qualifying child organizations that are available for you to make a donation to. And here's the best part. You can make a donation to these type of organizations until April 15th of next year, 2026, and they will be valid for 2025. And here's the deal, right? So we talked about that above the line charitable deduction. So let's say if I went to January 1st of next year to make a donation of $500, let's say, and I'm able to take my tax credit in 2025, but I also deduct that donation in 2026. So it's a win-win from my perspective. But again, if you're a charitable person and you want to tell the government how to use your tax dollars, definitely look into this. So here we are, questions and answers. What kind of questions you guys have? None?
This is so helpful. I had actually personally had a question regarding the 529 child accounts. Are those tax deductible? Because I've heard two different, stories about whether they are or not.
Not at the federal level. At the state, yeah.
Okay. And are you required to have a state account, meaning like whatever, whether you use Fidelity or any other program, do we have to check before we create a 529 to see if they are state level approved?
Oh, yeah, okay, sorry. Can you rephrase the question again?
So are all 529 accounts state at the state level tax deductible? or do they have to be with certain organizations or financial institutions?
Oh, no, no. I mean, if there is a financial institution, and I have no kids, so I really don't know much about this, but I mean, my assumption is you have a financial institution, which most people do, is as long as the financial institution is approved by the state, then you should be okay.
Okay. Thank you.
Yeah, you're welcome. This is so easy. No questions. This is pretty good. This is pretty good. Let's see here. No comments, no questions or whatnot.
There is somebody was raising their hand, but not able to see. Oh, there we go, Nanette.
It was me. Do you have any tax advice on, I know that I think the governor has allowed people to build like tiny homes and things on their properties.
Like the ADUs.
Yeah, I believe so. Any
Uh-huh.
advice on that in terms of like a Schedule C? There's a lot that goes into that. It's not just the house, there's septic and electric and water and just, there's so much that goes into that. So any suggestions?
So is this would be the ADU casita or whatnot? Is this for a business, an Airbnb, a rental?
No, it would be a rental, just a regular rental.
Okay.
Like with travel trailers?
Gotcha, gotcha. So what you're saying is you want to build like a casita, okay? And then what kind of is a rental like what? Long term, short
Yeah,
term,
no,
Airbnb?
monthly, yeah, long-term, 6 month, a year rentals.
Gotcha. So I mean, depending on what it is, if they're longer term, longer than 7 days, you're looking at usually it's a Schedule E,
A Schedule E, okay,
right? Schedule E, which is part of 1040,
okay.
right? If they're short-term rentals, less than 7 days,
No,
that
these would
could be
always be long-term. There's a lot of people
long-term.
with homes and I've got 3.5 acres, so it
Well,
makes
there you go.
to
So
try
yeah,
to
I mean,
put
you're
a
looking
couple
at
of RVs on there to help people.
right. So that would be a Schedule E type of deal situation. You're going to report the income, and all your expenses or whatnot. So what happens? All these like the capital improvements that you make to the property, most of them are going to be capitalized and depreciated, right? So now, since you're going to be doing a lot of this work, I would definitely keep track of that. The expenses, keep the bills and organize it, and talk to your tax professional to see what's the most aggressive way you can depreciate these capital, all these investments that you made into these assets. Now, watch out though, because now are you a realtor?
No,
Okay, what kind of income do you have aside from this?
we own a consulting company.
Okay, a consulting company. So you have nothing to do with real estate,
Very
right?
different from this.
Okay, so rentals are considered passive businesses or whatnot. So depending what your situation is and your income and all that good stuff, let's say you have a big loss because you're trying to depreciate a bunch of things. You might find yourself in a situation that is called a PAL, passive activity loss.
Okay,
So what happens is you're not able to use your passive losses to offset your consulting income. So it just sits there until you have passive income throughout the same investment or something else. So sometimes I see people say, oh my goodness, I'm going to do X, Y, Z. I'm going to do a cost segregation study and I'm going to have a big loss. And then they find out that the loss is not lost, but suspended until you got passive income and how to offset that. So again, that's my suggestion on those things. Balancing act, right? Looking at the whole picture, just not only the rental portion.
there's no question that the first year, potentially into next year, but definitely this first year has been the most expenses in regards to travel trailer. And then again, putting in water, septic, electric
Right.
is outrageous.
Yeah.
So,
Right. Yeah. Yep.
so I don't anticipate it would be nearly the loss next year, but our business is under a schedule, I mean, is an S corp.
Okay. Great. Yep. Yep.
So completely separate.
Right. Right.
So
Right.
would there be any kind, there wouldn't be any kind of a mix, because it's completely separate.
Right. So I guess what I was trying to say is the following, right? So you have an S corporation, right? I'm assuming you have W-2 income from that S corporation, and you also
Yes.
have the profit the income, right?
Right.
So the S corporation income is in an active business. There's an
Yes.
active business, right? You're not able to use a loss to offset passive
Oh, no.
losses. So, because I've seen people say, "Oh my goodness, I'm going to have a big loss. I'm going to lose money," but that's great because I'm going to offset this. And there is a couple caveats or whatnot, and that's going to be depending on the income, and we're just going to get into the weeds. But no, again, is your income again? Maybe it's just TMI, right? Is it over 6 figures on your business?
Yes.
Okay, so yeah, there is the chances for you to use that loss uh, probably are very slim. So, we will have to get into a very detailed conversation to see if there's any other options to see what, if you're able to use that loss.
Would it make sense for us to almost create a secondary business that would be just the properties and they act completely separate?
Oh, no, no, you still, that's what I'm describing
It
right
would
now. They're two
still be the
separate
same thing.
businesses still because it
Okay.
falls
It would
under
have-
the passive activity.
Okay.
Right now, there are certain instances it could be that business, the rental business, it could be a